Roth accounts are a great tax reduction tool in retirement. However, there are two specific rules that if you are not aware of, could be very costly to you. And in this video, I want to share with you those two very specific rules so you can make sure you are in compliance with the IRS. But before we get there, subscribe to my channel. I have over 30 years in this business. I want to share with you the conversations that I have with my clients so that you don't make the mistakes that they might have. So I've said over and over again on this channel, I think our industry has done a lousy job of preparing you for retirement. All the messaging is about, the more money you accumulate, the happier you'll be. You'll be able to pursue your dreams. But the reality is, there's so much focus on the Benjamins, there's not enough focus on the planning. And a part of the planning is how to make sure that you tend to the taxes and the retirement distributions properly. And there are some advanced planning strategies that are available to you that you may not be aware of. And there are tax landmines that if you step on them could be very costly. And this is why I wanted to put this video together for you, because there are two specific rules with regards to Roth required minimum distributions that you need to be aware of. Before I get to those two specific rules, there are two items I want to share with you that we talk to our clients about a lot that seems to be something they were not aware of, again, because I think our industry's done a lousy job. The first is, and I'm guessing you've heard about the whole term of diversification, and you think about it in terms of your investment portfolio. But have you ever thought about properly diversifying your retirement accounts so that you can take control of when you get the income and how much in the way of taxes you have to pay? We call this the income faucet. Roth IRAs are a wonderful part of that diversification strategy because you can turn on and off that income bucket whenever you like because there are no required minimum distributions for the owner. And in terms of taxes, you don't have to pay any on it as long as you've owned it for 5 years or more. It's a great tool, and the diversification of your retirement accounts to include Roths can be a very useful strategy. The other thing that I want to talk to you about is just whether or not a Roth is good for you. And we have a video on that. You can take a look at it when you have some more time. But one of the items I want to talk to you about, and I just had this conversation with a client of mine, I basically said to him that if he waited any longer, converting to a Roth probably would not make any sense for him because there's an upfront cost to doing a Roth conversion, particularly if it's a sizable number. So if you're thinking about Roth conversions, don't wait too late. Have this conversation with your financial advisor, your tax accountant, to see whether or not you're in a position to take advantage of it. Because now there may be a cost to you now, but later on there may be a tremendous benefit, particularly if tax rates are going to go up. You'll pay taxes on a much lower, smaller amount now, but get on a larger amount and pay nothing when tax rates are higher later. It's something to truly consider. So let's start off with the two specific rules you should be aware of, and we'll start off with the Roth 401k. So let's go to my screen for just a moment. So let's take a look at the Roth 401k RMD, required minimum distribution. The RMD rules apply to all employer-sponsored retirement plans, including profit-sharing plans, 401ks, 403bs, 457s. The RMD rules also apply to traditional IRAs and IRA-based plans. This is the sentence you need to be aware of, however. The RMD rule also applies to Roth 401k accounts. However, the RMD rules do not apply to Roth IRAs while the owner is alive. So the simple solution is rolling over your Roth 401k to your Roth IRA. Now remember, one of the caveats here is you're not allowed to take out within the first 5 years of a Roth your earnings. They would be taxable. You would get penalized. But if you can wait a period of 5 years, then all the money that you rolled over and all of the earnings would be available to you on a tax-free basis. Now on this next slide, we talk about IRA beneficiaries after the Secure Act. Now it's important to understand that there's sort of a differentiation in terms of timeline. Prior to 2020, when the Secure Act came out, there's a different definition and different rules for stretching out your IRA. So you need to go to your tax person or your financial advisor to see whether or not you qualify for those distributions pre-2020 and before the Secure Act. For anything after that, there are 3 different buckets here, and the one that I want to focus in on is the middle one, the one for designated beneficiaries and what we call non-spouses. Now, if your spouse is the beneficiary, then he or she can do what he or she needs to do over their lifetime. But if it's a non-spousal beneficiary, then the rules are very different. As a result of the Secure Act, the designated beneficiary, particularly if it's a non-spouse, like from inheriting a Roth IRA from a parent, there is a 10-year distribution rule that from the moment of the inheritance to 10 years out, the money needs to come out. If not, it will be penalized for non-compliance, and it's a 50% tax penalty. Now, my suggestion to you, and again, I'm not providing financial advice to you, but just something for you to think about. If you don't have to take it out immediately, and let's say, for instance, you have a $500,000 Roth inheritance and you're a non-spouse, maybe you delay taking it out to as late as possible. Let's call it 10 years out. Let's assume some numbers. Maybe you can get a 5% return on it over time. No guarantees, just as a number for our purposes. In 10 years, that $500,000 has grown to about $815,000. So if you can take the money out free, would you rather take out $500,000 or $815,000? So this is where talking to your financial advisor can be very helpful to you, because the benefit of this is all in the planning and making sure you can coordinate the Roth IRA and make sure that you understand these 2 specific RMD rules to Roths, where typically there are no rules to require you to take the money out, but in these 2 specific instances, there are.